20 years ago, I bought my very first property and I held it for a few years, and when I sold it, I made $65,000. Now, I had a mentor showing me the ropes, so honestly, I didn't make too many mistakes. But it's been over 6,000 deals since then, and I'm telling you, I've learned a lot in the last $2 billion of real estate. So when I got started investing in the game of real estate, I got really curious with my mentors on which strategy I should lean into. Was I gonna do multifamily and try to buy up like apartment complexes? Was I gonna flip real estate? Was I gonna do wholesaling? Was I gonna develop land and turn it into neighborhoods? Well, out of all of those strategies, it turns out that there is a singular strategy that makes the most money, but with the least time and the least effort and the least risk. And I want you to think about what that really means. To make the most money, but you don't have to put in the time, the money, the risk. So what I'm gonna do today is I'm gonna share with you 5 tips that when you combine them all together, actually form my strategy on how you make the most money in real estate with the least time, the least effort, and the least risk. And here's the first one right off of the bat. When you invest in real estate, we buy single family homes. And generally these are newer homes. You're looking for something that is at least a 3-bedroom, 2-bath, or maybe a 4-bedroom, 3-bath. And the reason why I recommend you start with single family is that it's the least amount of money you've got to put out to get in the game. Like, you can even house hack your way into the strategy like I did. When I got started in the game, it was a very entry-level 4-bedroom, 2-bathroom home. It was a 3-1 upstairs, and then it had a basement apartment that I rented out, and it was a 1-bedroom, 1-bath. And that was one of the least expensive types of real estate that I could possibly buy, and I got in with a 3% down payment. So single-family homes usually produce really high return on investment, but they're the most accessible to get into. Like if you wanted to do a land deal and they want 50% down on a development project that's $1 million, you need $500,000. Or if you want to buy like a $2 million apartment complex, you might have to come up with several $100,000. But single family homes, this is for you as a new investor, this is the most accessible and easy type of investment to get into. Okay, here's tip number 2. Buy the real estate below the median. And I want to describe what that means for just a second here. For all intents and purposes, I want you to think of a median kind of like, well, what's average? Like right now in the country, the average purchase price of a home nationwide is around $430,000. So here's what I can tell you. If you're buying a home below the median for like $200,000 or $300,000, in that price range, you have the most people looking for that house. Above the median, let's just say it's a $500,000 house or $1 million house, you have a much smaller group of the population looking to own real estate like that. So as a new investor, not only are we targeting single family homes, but we're also targeting a price point of real estate that most people can get their hands on. And that means that it's the easiest kind of real estate to transact, because how many people are looking for $1 million home versus how many people are looking for an entry-level home? The other reason why I like to buy below the median is because every decade or two, the real estate market will soften or even dip. And $1 million house could become a $500,000 house if this was a major real estate correction. But a $300,000 house doesn't become a $100,000 house. It might become like a $260,000 house, in which case you're gonna still hold on to it, you're still gonna rent it, and even if the market goes down, you don't have to sell it and you don't have to realize a loss, you can just keep it in your portfolio. So buying real estate below the median, it's for protection. Number 3, we're gonna buy this home, we're going to rent it out, and we're gonna hold it for the short term. That means I might hold this home for 3 years, 5 years, or 7 years. When we do rentals, what we're focusing on is something that can be passive, because I can have another property management company actually get this thing rented out. And the reason why I hold it short term is because the longer you hold property, the more damage you're gonna incur, the older it's going to get, the more things that you're going to have to actually fix up on the property. But if you hold it for 5 years, that's enough time for the property to go up in value, get some of it paid off, and when you sell it, you now get enough money back generally to not just buy another home, but now buy 2 more. So I'm literally trading 1 home for 2 homes, and later I can trade 2 homes for 4 homes, and later 4 homes for 8 homes. And so we don't hold these homes forever because we have a chance to actually put it into newer, better real estate where we can multiply our money. Bottom line is, once you've held a home for longer than 7 or 8 or 10 years, you start getting a diminishing return on the ROI. So we're going to basically sell it before that happens. Number 4, I want you to buy this real estate in what we call the path of progress. In other words, there are neighborhoods and areas where you live where the market is kind of in decline. It's maybe lower income housing. People aren't taking care of those neighborhoods. But now you have other markets where it's like, wow, it's trendy, it's exciting. Those markets appreciate better. Like in the extreme, I only invest in the top 5 markets out of 324 markets that make up the United States. But where you live, in your city, there's a path of progress. There's an area where the ROIs are gonna be stronger. And so we invest in the path of progress because we want that real estate to go up the most in the shortest period of time. The 5th piece of advice, and perhaps the most important thing that I can share with you right now, is all about 3 letters, ROI. It stands for return on investment. And it's a very simple equation. Like, let's just say for just a moment here, I got $50,000. And so in the equation of ROI, it's actually very simple math. My gain divided by my investment times 100 is going to tell me what my ROI is. So for example, let's say that I bought a house, and let's just say that I used $50,000 from a 401k or an IRA or equity in a prior home, and I pulled it out and I put it in this investment property. So if you look at it, it's like, okay, my investment is $50,000. And 5 years later, I sold that investment and I made an additional $50,000. So my gain is $50,000 divided by my investment of $50,000 equals 1. 50K divided by 50K is 1. Then we times it by 100. And what we find out is we had a 100% ROI. And let's just say for a moment that this happened over 4 years. So then I'd say, okay, my total ROI is 100%. That means that I doubled my money. Makes sense, right? I put in 50 and I got 50 back on top of my original 50. But now I want to know what my annual ROI is. So I take my 100%, I divide it by the number of years I was in the investment, and what I learned is that I was averaging a 25% annual ROI. Now, I never touch a real estate deal unless I'm earning at least 25%, because it means that my money doubles every 3 years according to the rule of 72. Because that real estate compounds, it's a really big deal. And compare this to your 401k. Your 401k right now on the 20-year average is producing 4.1%. I want you to think about that for just a second. So you are outmaneuvering your 401k massively. If you put money in your IRA, your 30-year average might be 5 or 6%. So you're kicking its trash. If you're thinking, well, what about the equity that was sitting in my home? Well, nationwide, average equity goes up 4.6% a year. Again, you're more than 5 times that. There's a reason why real estate creates millionaires, and this is the number that you need to prove it. In other words, I have a standard. I will not buy a property unless it's single family, it's below the median, it's a short-term rental, I'm renting it and I'm holding it for the short term, it's in the path of progress, and my ROI has to at least be 25% a year or more. And if it is, I'm gonna pull that trigger. Now, I'm not just giving you a lot of information today, I also wanna give you a free opportunity. What if you had a chance for me as a multimillionaire to step in your shoes and provide some advice on step-by-step what you could do as your next move to become your own millionaire or next multimillionaire? If you'd like to get that, it's what I call a free game plan. It's basically me stepping in your shoes and saying, okay, like if I woke up today and I had your job, and if I had your income, and if I had your financial situation, if I had your good credit or your bad credit, or if I had all your other life situations, what would I do to become a multimillionaire as fast as possible? And if you'd like to get my perspective for free, all you got to do is click the link below and request a free game plan. Literally click the link, drop in your name, phone, and email, and I'm gonna have a member of my team reach out to you and show you step-by-step what I would do to become a multimillionaire next if I were you. Well, my friends, that's what I did to become financially free. But if you really wanna know why I did it and what was motivating me to achieve that in my mid-20s, click right here and let me show you what my journey was like when I just started out and why I invested in all this real estate in the first place.